David McWilliams' book, Money, A Story of Humanity, published in the second half of last year, was on my reading list over the Christmas break. This book is an extremely interesting journey through the global history of financial innovation, from potential signs of an early commercial ledger scratched into a bone found in the Congo, right up to the introduction of digital currencies in the present day. It makes a strong argument that the evolution of money as a social technology has played a central role in almost all of the major developments of civilization, as well as on several occasions destabilising the world order. It's a fascinating historical summary, and I found it really insightful in showing just how frequently shifts in trade patterns and those major financial power struggles have occurred through time. Topical as we continue to digest the current economic regime and support for more populist political rule in many parts of the globe. This week's episode is the final in a three-part mini-series where we've discussed the macro backdrop with economists and strategists in the asset management industry. We were delighted to be joined by David Rees, Head of Global Economics at Schroders. Welcome to the Investor Insights podcast, hosted by Killick & Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on topical issues. You can access the full series of interviews via the playlist on the Killick & Co YouTube channel, or by searching for Killick & Co's Investor Insights on Spotify, where you can subscribe and be notified of future episodes. We hope you're enjoying the discussion so far, and you can get in contact with us about any of the topics discussed via the email address investorinsights@killick.com. Killick & Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details on the unique ways in which we do that at our website, killick.com. In this week's episode, we were joined by David Rees, who was recently appointed Head of Global Economics at Schroders. David joined Schroders in 2020, having previously held a number of economics and strategy positions throughout his career. This interview was recorded on the 7th of January, and David references some publications that he and the team have produced in recent weeks, and we provided links to these in the episode description, should you wish to read up further on the team's views and to take a look at some of the charts which may help to visualize some of the statistics discussed in the episode. As always, please do get in touch via the podcast email address if you have any questions on any of the topics discussed. David, good morning. Thank you so much for joining us, and Happy New Year to you.
Happy New Year to you as well, Gordon. It's great to be here.
So we've got this kind of standard opening question to these, which I think we've asked everybody in the series so far, and it's kind of, the question is really just designed to kind of get a bit of an insight into kind of how you go about your work, or a bit of an insight into you, really. I wondered if there was a kind of anecdote from a recent meeting or something from a current research project you could share, or even just a kind of book or article. We've had some book recommendations here. Anything you could share just to give us a bit of an insight into you?
Yeah, well, actually, so usually my coverage is and interests are quite broad because my background's in emerging markets, which means I cover about 3/4 of the world. And increasingly, I start to look at the global economy. But actually, for all of that, usually we keep it on top of the kind of geopolitics and everything. Frankly, the last 3-6 months has all been focused on one figure. That's been Trump, to be honest. And I suspect that's going to be a bit of a running theme through this entire conversation, and indeed a lot of conversations that everyone's having at the moment, because obviously Trump is going to be coming in on the 20th of January, and no one's quite sure what's going to happen. That's, for economists, I mean, look at all the kind of projections of a recession in the US over the last couple of years, which were completely wrong. Economists usually struggle to take one or two variables and come up with the right answer. And now we're trying to kind of play 4D chess with all the different kind of comments that are coming out of Trump. Then you've got the mouthpiece of Elon Musk at the moment. And then you've got all the appointments, and everyone's trying to put all this together and come up with a conclusion about what it means. And frankly, we just don't know. So we try to get on top of this. I mean, as economists, we know that usually we're going to be wrong anyway. But what we do at Schroders, which I think is quite useful, is that when we publish our baseline forecast, we, around that baseline, already come up with 5 scenarios where we're likely to be wrong, how we're going to be wrong, what are the signposts, and what would we do with the portfolio if we're going in that direction. So we've been doing a lot of work around the baseline, which we can talk about, I guess, on the US section in a moment, which makes some assumptions that he's going to do some things, but it's not going to be all that extreme. But actually, we just published a paper just before Christmas on what if he isn't bluffing, what if he does everything he says, and what's going to happen to the world economy. And so a lot of work has gone into that. And basically, the world has been less synchronized since COVID. Frankly, the US has been out on its own and the rest of the world's been kind of weak. And if Trump kind of went ahead and did everything he said, you kind of get the feeling that that would even diverge even more, that the US maybe kind of stagflationary kind of outcome, whatever, but the rest of the world probably tips into recession. And so we've been doing a huge amount of work around there, what it means for asset allocation.
Yeah, no, thank you for that. Yeah, some important points in there. I think the kind of acceptance of not being able to forecast, particularly over the short term, but just thinking about scenarios, kind of really useful from our perspective as well. David, what I thought we'd do is kind of slightly different conversations to our kind of usual. We're usually talking to fund managers. We've had a couple from Schroders over the last year, but these are slightly different conversations. So what I thought what I do is kind of split it up into three parts, I guess, because it kind of as you mentioned, there's kind of lots going on. What I thought we'd do is kind of start with the kind of economic backdrop, try and kind of cover maybe whiz through a few more areas of the world in terms of kind of outlook for the economy, and then we'll move on to kind of what that means for markets, market outlook, and then if there's time at the end, we'll maybe do a few kind of quick questions on the risks and certain other things if that's okay. Uh,
Yeah, absolutely.
so maybe if we start with the US economic backdrop, because clearly, as you've just mentioned, there's kind of plenty going on, and most of the kind of attention of people like yourself is clearly on Trump. Could I ask you to maybe just go into a bit more detail, kind of how you are viewing the outlook there, and what are the key considerations that you're looking at the minute?
Yeah, so we've been pretty bullish on the US for some time. We were top of the consensus for growth, really, give or take, throughout last year because we felt that the US consumer was in aggregate in really good shape. And actually, that view has more or less played out. We've kind of, when we did our latest forecast in November, kind of an exercise of market to market, really, for 2024. We moved our forecast up from 2.7 to 2.8. So, just adding a tenth for 2024. That was, as I said, based on the idea that the US consumer was in really good shape. And there's obviously been a huge amount of focus on the labor market in the US, but really what happens in the labor market today matters for the economy in like 9 months' time. If you just draw a very simple chart, which has been a very good basis for the view over the last year of real wage growth in the US against consumption, there's historically back to the 60s, 70s been a very good relationship. A real wage growth as it stands is supportive of consumption growth of somewhere in the region of 2-ish% over the next 9 months, which is a very good basis for a growth forecast already. And so when we took that and the fact that the Fed started to cut rates a bit more aggressively than we thought they would, starting with that 50 basis point cut, we would have been revising growth up this year anyway. So originally we would thought that the US economy this year would be growing at about 2.1%. We've now moved that up to 2.5. So in part because we think the US consumer is in good shape, but also because we made a whole boatload of assumptions about the policy mix under Trump, because you can't just say, "Oh, we don't know," and hold your hands up. So we made a boatload of assumptions, which essentially, if you boil it down, we assume that Trump is going to basically wash out as being pro-growth, pro-business, and although he's talked a big game on deportations, on tariffs, etc., we assume that there's going to be some deportations. We assume there's going to be some tariffs, but in a measured way that won't sink the economy. And actually, we think that if you get a little bit of fiscal stimulus, that will be difficult because although we've got the red sweep, he hasn't got control in Congress, right? It's going to be very difficult. There's going to be horse trading, but you can imagine a big publicity, headline grabbing, jobs and whatever type act coming through that ultimately will boil down to a little bit of fiscal loosening, a little bit of deregulation, probably on financial services, on fossil fuels, what have you. A little bit of tariff, but to extract deals out of trade partners. You could imagine him strong arming China and Europe maybe into buying US oil or whatever to try and make a bit of two-way trade. So a long way of saying that we think that it's going to be pro-growth. So we've got growth in this year for the US at 2.5, and actually 2026 could even be a better year because it would take a while to get changes in regulation and fiscal policy through. And so actually the effects of that, once you take the lags into account, would be more a kind of 26 story. So we're quite positive on the US, basically, from a growth stance. The issue is that if you kind of go back to your economic textbook and think about an economy that's growing above potential, probably potential growth in the US is 2.5%, something like that.
Yeah.
It seems like the US is operating above potential. Most estimates show you've got a positive output gap in the US, and now you're pouring on more above potential growth. So that output gap is going to push more into positive territory, and ultimately that's going to end up in inflation, you would assume. So we don't have runaway inflation, but at the same time, we have inflation getting stuck in the region of 2.5% to 2.7, something like that, over the next couple of years. So on that basis, we don't think there's a lot of room for interest rates to fall much further. And actually, we've penciled a couple of hikes in for 26,
Really.
consistent with that view. I mean, that's quite fluid. As I said, we made a lot of assumptions, but we don't see a lot more rate cuts. And we think that ultimately that growth mix would mean that rates would need to go up again at some point down the line.
Yeah, yeah, great. Now we might come back and talk about the implications of that kind of inflation outlook shortly. But maybe let's move on to Europe and the UK. I mean, a lot's been written about that kind of divergence in economic performance that we've had for a little while now, and obviously you weren't sensitive to what's going on in the States. But can I maybe ask you to kind of talk through how you're thinking about Europe and the UK at the moment, from a economic outlook perspective?
Oh, so it's quite challenging, isn't it? So actually, when we look at the global economy, and if you look at some of the things, like one of my favorite indicators is real M1, and it's historically been a pretty good guide to the global cycle and particularly turning points. And if like listeners go on our website and find, we release a chart pack that goes alongside our forecast document, and so you can find it there. There's a load of charts of this kind of stuff, but up until the kind of past 18 months, real M1 has been a very good guide to kind of where there are cyclical turning points in things like the global composite, PMI, what have you. It's all broken down over the last 18 months. But when you look at those kind of monetary aggregates and the loosening in financial conditions in, for example, Europe, you're starting to see those kind of monetary aggregates start to accelerate again. Now, part of that's base effects because of all the kind of washout from post-COVID. But part of that is that financial conditions have loosened quite a bit. It looks like that's going to extend. And so at some point back half of this year, we're kind of assuming, certainly in Europe, that you could see a bit more of a kind of cyclical upturn coming through in some of the growth numbers. The kind of issue in the meantime is that things feel a bit stagflationary. I guess that fits with both the UK and Europe, where actually growth in Europe's been a bit better, or it feels like it has. But it's not been all that great. You basically had two economies that have been more or less not really going anywhere for 18 months, 2 years. But despite the fact that the economies haven't really been going anywhere, inflation has been sticky and labor markets haven't really cracked. You've got this kind of dynamic where services inflation is elevated, and that's your biggest input cost in services tends to be wages. Wages haven't been crashing down because unemployment has been quite sticky. It is kind of hints to this idea of demographics and shortages of workers, in Europe and the UK, and then you kind of layer on the kind of the populist shift that's going against immigration and all of that. So it feels quite stagflationary, certainly in the UK. But we do see grounds that you can get a bit of dynamism coming into these economies um, second half of the year because of that loosening of financial conditions, because of a bit of reduction in interest rates. And in the case of the UK, there ought to be a bit of support coming through from fiscal policy at the margin after the budget. A lot of focus has been on the negatives out of that budget, but there ought to be some loosening of fiscal policy coming through to help growth. So, again, that can be supportive of growth. We don't really think that growth's going to be gangbusters. Far from it. We've got a forecast for the eurozone this year 1.2. UK around 1.5, so the UK doing a little bit better. That's frankly not a million miles away from consensus. I think we're kind of marginally above consensus, but not much.
Yeah.
But again, the concern in all of that would be that if you do get a bit of dynamism coming through to growth, which at the margin ought to be consistent with a bit more demand for labor, then this kind of decline in services inflation probably hits the buffers in the middle of the year and you get inflation being stuck above target. So again, the concern that we have, I suppose, globally is that inflation is going to be a bit stickier than people generally assume, and therefore interest rates won't come down all that far. And so then that kind of stunts the outlook for growth further ahead.
Yeah, yeah. Yeah, no, thank you for that. We'll maybe put some links to those money supply charts that you referenced in the description. You referenced in your first in the first question, you kind of spent a reasonable part of your career at Schroders specializing in emerging markets. I did want to spend at least a little bit of time looking at emerging markets, just kind of get your kind of expertise there as well. I mean, and China was one of the other kind of big stories of last year. That kind of policy pivot, I guess, the kind of the stimulus packages that were announced in the autumn. I mean, that was kind of one of the big stories that of the year. But could I ask you to maybe just kind of talk through how you're interpreting things that are going on in China and elsewhere? If there are the kind of key points that you want to make.
Yeah, so I mean, when it comes to China, I mean, we've got quite a weak growth forecast. So I actually cut the forecast for this year to 4%. Now, there's always a tension between what's actually going to be printed and what's really going on the ground. And, obviously the 4% is slightly provocative because presumably, unless things really go wrong, they're not going to print a number of 4%. But I think in China, there is clearly an issue that the cyclical outlook for the economy into the middle of this year is really weak. And the reason I say that again, I mean, again, I'd go back to the real M1 indicator, which for China is like the premier cyclical indicator. But also, if you look at things like the credit impulse, what you kind of pick up in these indicators is weakness in the private sector, a lot of which can be traced back still to what's going on in the housing market. And so you've got very depressed sentiment amongst consumers, and you've got very weak demand for loans. Private sector demand for credit is very weak because historically people have generally taken credit and bought a house with it. And so even if mortgage rates have been falling, there's a fantastic chart of mortgage rates against mortgage borrowing. Since the housing crash, that relationship has completely broken down. So even if interest rates have been falling, there's absolutely no demand for credit in the private sector because no one wants to buy a house. And so that's a bit of an issue for kind of policy transmission through things like monetary policy because, whatever the price of credit at the moment, no one wants to borrow. And so you've got this weakness in the private sector, which needs to be offset by fiscal stimulus and intervention effectively. And so that's why this policy pivot is important if it can work. And so the concern that I have at the moment is that, I've been making the argument that effectively, if you want to see growth of 5%, say this year and next, so effectively meeting the growth target, you probably need a fiscal stimulus of something like 4 to 5% of GDP. But also the shape of that stimulus will matter because, as I said, interest rate cuts, then they will have some effect, but they're not going to be all that impactful because the housing market's broken. A lot of kind of stimulus historically is focused on things like infrastructure spending. Well, how much can you continue to build infrastructure when you've got kind of overcapacity? Same for investment in manufacturing. So that seems a bit of it can work, but the bang for buck is going down. And so really you need to see things that are going to go out and outright stimulate demand, and preferably on the consumer side. And so that's kind of what we're hanging on. And we've had a lot of warm words within that policy pivot late September, in the readout from the Central Economic Work Conference in December, from President Xi in his New Year's address, explicitly talking about these kind of issues. So there's a lot of warm words, but so far we don't have a lot of money on the table. So at the moment, and so our kind of forecast is based on the idea that, frankly, we've heard a lot of warm words over the last couple of years and not seen much action, and kind of lost faith in the idea that there's going to be a big follow through, which explains the weak forecast. But then again, in our scenario work, we do have a China stimulus scenario, which we could then tilt towards if we do actually see that this support is coming through. And I think the key thing to watch in the first half of this year, or frankly, the first few months of the year, will be the speed and size of government bond issuance. Rather than all the talk, let's see what's actions speak louder than words and all that kind of cliche. But let's see what's actually done, because if they do start issuing aggressively in the first half of this year or the first few months, then that would give me greater confidence that actually they are going to do the business and sustain growth at closer to 5%. And that will obviously be pivotal for things like Chinese equities, in terms of the domestic story. Of course, all of this then ignores the fact that I've just said that Trump could come and sink the ship
Yeah.
by putting a 60% tariff in place.
Yeah.
So that's the kind of push me, pull me a little bit when thinking about China. But on the domestic side, certainly stimulus is key. And then we have to see what comes through on trade policy.
Yeah, no, absolutely. Yeah, lots of moving parts here, but but another kind of key market to keep an eye out, as you say, as we kind of go through this quarter and next. David, let's maybe move on to the kind of market itself, and kind of obvious place to start would be kind of equity markets, and I guess the kind of Trump election kind of markets kind of reacted pretty positively to it, certainly initially, but kind of given that we kind of sat with valuations kind of somewhat heightened, kind of concentrations pretty high in certain areas. Could I ask you another kind of big topic? Could I ask you to maybe just kind of lay out kind of how you're looking at equity markets at the minute?
Yeah, so I mean, it's really difficult on the US on the kind of S&P because of that concentration, because of the tech sector. And I'm like a layman economist, so I don't really understand all this like high tech stuff, right? So, I mean, it's really difficult. But I mean, ultimately, if you're talking about continued US exceptions, the US exception has been a key driver of markets over the last couple of years,
Yeah.
and it's driven outperformance of the US along with the tech side. On the tech side, it's really hard to know what's going to happen. I kind of defer to our kind of expert fund managers. But I guess if it seems like there's outright demand to justify the valuation of these stocks, even if there isn't, bubbles could inflate for a while longer. And is there obviously a catalyst to come along and knock that out? I'm not sure. The one thing that might do would be these kind of rate hikes that we're talking about in the US. But again, that's more a story for 26. So presumably that doesn't get priced in for a while. So, that presumably can run. We have been discussing a lot and playing kind of broadening out type themes. And I think in the near term, the kind of US outperformance means that broadening out is probably within the US market. So maybe, I mean, when Trump first came in, things like small cap started to do well, and then you got a reversal. So maybe those kind of trends can come back, kind of S&P equal weighted or financials type thing, or the idea of deregulation, yield curve, etc. So that's something that could happen in the near term, and then maybe kind of more to the middle of the year, you could start to see some broadening out on a regional basis geographically. I talked about this idea that the monetary aggregates in Europe are starting to come back. Maybe that could start to be supportive. The wrinkle you've got there, of course, is you've got elections in Germany and probably France to
Yeah.
contend with, and a lot of political upheaval. When, of course, I mean, we haven't even talked about Russia, Ukraine. There's so much going on,
Yeah.
but you've got all that going on in the background as well. But maybe you could start to play broadening out through that kind of that kind of axis, and also, I mean, in our baseline view, and again, I would refer people to the chart deck, but um, if you do see this cyclical bottom coming through in China around the middle of the year, I mean, typically those leads give us an idea of what's going to happen to earnings expectations for things like MSCI China with a lead of about 6 months. So if you do start to see that trough build, then you could start to see expectations for things like China start to improve even. and even broaden out into those markets, subject to what happens with trade and tariffs. But yeah, so I think near to US exceptionalism, and then maybe we could start to broaden out further down the line.
Yeah, that's certainly a trend that we're hearing from underlying fund managers as well. That kind of opportunity set being slightly broader than it has been. David, can we maybe go back and talk about kind of inflation again, and but in the context of the implications of that on interest rates and fixed income and kind of credit markets? You mentioned that kind of potential for rate hikes even kind of a year out, but kind of can maybe run through kind of how you're looking at fixed income markets at the moment in that context?
Yeah, so I mean, it's really tricky ultimately because, um, again, I mean, we just have less rate cuts in our kind of
Yeah,
expectations in
yeah,
our central scenario, and actually a kind of scenario probability weighted kind of profile. We just have less rate cuts than the market,
yeah,
particularly the US, but also in Europe, where um, as I said, inflation is sticky. We think that inflation will be coming down, but kind of gradually. And, we at the time we're talking, I mean, we just had a print yesterday where German inflation looks like it's picked up to around 3% on the initial reading. So, that's not consistent with aggressive rate cuts. So we think that, central banks in will be cutting a little bit more in the near term. But for example, for the Fed, we only have one more cut to come,
yeah,
and we've got two more cuts for the ECB and the Bank of England, and then we think that's more or less it because growth and inflation won't justify further easing.
sure.
So that makes it a little bit tricky for rates on the front end of the curve. And I suppose then at the longer end of the curve, something which I suspect is going to be a major topic this year is sovereign debt and sustainability of debt and what that might mean for the longer end of these kind of fixed income curves. So, obviously, if we're completely wrong on the economic outlook, you get a recession, then fixed income is going to do really well. All bets are off.
Yeah,
But we're just a little bit concerned that yields are going to drift higher, I guess, in this environment. So you need to be quite tactical in that environment, I suppose,
yeah,
with treasuries, because we had this kind of really, really big debate at year end about, treasuries look appealing on kind of historical valuation models, but then, yields kept rising
yeah.
on the kind of anticipation of Trump and US growth. So yeah, it's tricky, I think.
Yeah, it's going to be a fascinating year from that perspective, looking at kind of Fed policy and what's happening at the government level. Um, David, just with the time at the end, I wondered if I could just kind of race through a couple of areas, just maybe stuff we haven't talked about, and what one of them is being kind of some of those tail risks. If I was to kind of ask you, kind of what worries you the kind of most about markets, what's kind of in that kind of tail at the minute that kind of keeps you up at night?
Yeah, so the obvious one is Trump, but let's part that to one side. So I
Yeah,
think inflation is still a concern for me. I think there's enough evidence in the US that it's going to be sticky, and probably it already is sticky in Europe and UK. So I'm a bit concerned about inflation, and as I said, concerned that about fiscal and sovereign debt dynamics, because ultimately fiscal dynamics, particularly in the US, are poor. They're not going to improve and they could worsen. And that's going to need to be funded. And so ultimately, the way that it gets funded is you attract capital in through pricing, right? And so it kind of suggests that yields are going to be higher.
yeah, yeah. And you've kind of mentioned as we've kind of gone through how you view yourself, your own kind of team's view in that versus kind of consensus. But if I was to ask kind of what you would view as your kind of least consensus view at the minute, would there be a kind of area, kind of something you point to there?
So our biggest non-consensus views are really on the US, and in particular the idea that this macro setup is going to lead to rate hikes.
Yeah,
So
yeah,
I think that's an obvious one, and I think probably the weakness of growth in China. We're quite a way below consensus. As I said, a caveat that. So I think it's really the US exceptionalism leading to rate hikes is
yeah.
the most non-consensus view.
Yeah, certainly not something that which everyone's talking about. And again, hopefully not the kind of trickiest one. But if there was one kind of highest conviction area or strategy at the minute, would you've kind of talked about the kind of broadening of markets, but if there was one area that
So purely from the macro side, my biggest conviction is still on the US consumer.
yeah,
I mean, a lot of people keep trying to talk down the US consumer, but frankly, as I said, from our point of view, The consumer looks rock solid, and we think that they're going to continue to spend. And if they wanted, they've got room to lever up and borrow a load of credit because the
Yeah.
banks in the US are ready to lend. Interest rates are drifting down, and they could even lever up. So I think the US consumer for me is the biggest conviction.
Yeah, no, that's clear. David, that's been super interesting to kind of run through. Always tricky, kind of putting everything together and kind of doing it in such a short space of time. But appreciate you you joining us today. Thank you.
Yeah, it's a pleasure. It's great to speak.
Thank you for listening to the Investor Insights podcast, hosted by Killick & Co. You can get in contact using our podcast email address, investorinsights@killick.com, for more information on any of the topics discussed, or for further details on the services offered by Killick & Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killick & Co is authorised and regulated by the Financial Conduct Authority, the FCA.